Our commentators, Mike McGlone, Bora Barryman, and Matt Stanley. Thanks, everybody. We're in Miami, we're in London, we're in Dubai. Let's kick off close to home with Matt Stanley, Director of Star Fuels in Dubai. Matt, we're on a tear. Is there anything to stop this oil price knocking on the triple-digit number?
No.
Okay. Good night, everybody.
Right. Morning. No, thanks. Welcome back, Sean. You've been missed. We've just come off a dollar. I don't know why. 88.80 we were trading 10 minutes ago, and now we're below $88. Look, it's a manifestation of so many things, and all of it centers around disruptions to supply. Anyone who's been in the market longer than a month knows that supply disruptions are nothing new. They happen all the time, whether that's Venezuela, as we've seen issues in Nigeria and Libya, and we saw issues in Kazakhstan. The amazing thing about this market is that the minute that there is a supply disruption, it gets priced in straight away, buys the market because there's not enough oil. And then the minute it's resolved, it doesn't correct itself. So I'm a little confused and concerned about that. When does that correction come in? Look, the issue yesterday and the issue this week, actually, the Wall Street Journal article on the Abu Dhabi attack was quite frightening, actually. I thought they went into some real detail there and some serious, wording on that article. So anyone who's in the region should read that. But yesterday was obviously the issue in Ceyhan, the Kirkuk-Ceyhan pipeline, 450,000 barrels a day of supply off the market. That's around 15% of what Iraq are producing right now. It's a key pipeline. It supplies the majority of the Mediterranean refiners with that Basra medium, Basra light crude. And look, the one thing that I'm watching on all of this, which has happened in the last 2 weeks, is what has happened to Dubai crude structure. The majority of Middle East crude, with the supply issues, that has roofed. That has gone from 20 cents backwardation to $1.30 in the front month. And that strength is there throughout the curve. So the market is certainly pricing in supply disruptions, but how much of those are potential supply disruptions and how much of them are actual? And that's what I think needs more detail before we can really see. It's going to push towards 90, but whether it can sustain it is going to be the key thing to watch in the next 2 weeks or so.
Bora Barryman, good morning, managing partner of Hormuz Straits Partnership. We had on earlier in the week Mike Muller of Vitol, who was already saying this is I think he used two verys, a very, very tight market. Before we had Ceyhan and the incident in Abu Dhabi, your thoughts on where geopolitics and the fundamentals of this price come together?
It's a very, I would say, concerning geopolitical environment compared to what we've seen over what we've come accustomed to over our lifetimes, right? We've never seen this much tension between the major powers since the end of the Cold War. So certainly there is this looming fear of disruption, but I don't know if that is what is moving the markets. Clearly, there's a focus on what the central bank policy will be, and inflation expectations are seemingly entrenched, and this is reflected in our real world experience, and an important part of that is the oil price. Now, yes, the consensus from the analysts is that the Fed will move on to 4 hikes in 2022, but inflation is still 7%, and we haven't actually seen any action, but certainly the tone has changed. Chairman Powell has changed his tone now that he's renominated and he expects to be reconfirmed. He doesn't need to talk up, other aims such as equity and redistribution, and he can focus on price stability. But I think the question is, will he act? And markets are skeptical. Whatever you see in the volatility of the major indices, they're still near all-time highs, aren't they? And likewise, oil is another asset class that is liquid, easy for investors to get in and out of and hedge themselves to a certain extent. and it's at an all-time high, or at least a decade high, basically. And when you have this pressure on prices, I'm looking at what's happening in Turkey. A lot of real assets are going up in value, even to the dollar, such as real estate, and people want to hoard or stock up. And clearly, if there are supply disruptions, if there's not that much oil on the market, and people are worried about what it will cost tomorrow, there will be a move to support the oil price today.
Boris, do you see the oil price, and it's been obviously a year in this journey, doubling and now beyond doubling, that oil and commodities, but energy as the trigger, as the driver of inflation, or as a reaction to the inflation? I mean, how much burden should it carry as a cause of this?
No, I would say it's certainly not the oil tail wagging the dog. There are more dollars out there. There's unprecedented stimulus out there. OPEC has been as accommodative as we could expect it to be, given that only two players have really spare capacity. And the other players are affected by the fact that it's difficult to raise large-scale finance for carbon-intensive industries today. And the major systemic banks are certainly more than an arm's length. I think they're at a 10-foot pole length from the oil industry. So I can't blame the oil industry for the inflation we're experiencing.
Well, not the oil industry, but ultimately the price. Let's go to Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. Mike, tough start for the year for a bear, for a cyclical bear. How do you read this at the moment, with the Permian literally batting, near record levels now?
Oh yeah, that's only going to increase, and that to me is the issue. When we are rallying because of supply issues, that's typically not enduring for commodities. You want demand pull, and it looks like it's incrementally peaking in China. It's peaked in the U.S. It's peaked in North America. And supply, this is just going to incentivize the main force that's pressured crude oil for the last 10 years, North American supply. So I think just looking at Department of Energy estimates, it looks like the key also measure, we're going to get pretty, record North American supply. I say North America because Canada is included in that. It should reach 27 million barrels a day this year. And demand peaked around 24 in 2018 and might get to 23 million barrels. So that's a problem. I think we're within ticks of making a high, and this is the way I think it works. Remember, it's the incremental relationships. Copper looks like it's peaked. So copper usually runs up with crude oil. Natural gas in the US peaked around 6. It's bumping up again 4 again. That's a key brethren for WTI. At least it's kicked back in again. And we're seeing it trickle down. So I look at it as, this to me is this, I see extreme bullishness everywhere and an enduring bear market. So I think it's going to roll over. And then there's the macro. Crude oil rallying is really bad for what's happening in the macro. It's just going to incentivize the Fed to tighten more. Now, they haven't tightened yet, as Boris mentioned, but they're jawboning. And to me, that's going to all revert back towards the ebbing tide. The Fed needs an ebbing tide, most notably in stock market, to alleviate these inflation numbers. And this is really bad for that ebbing tide right now. It just makes the Fed have to tighten more, crude oil going up. So I think we're within ticks of just hitting the stops above last year's high, which is going to be an enduring period going back down. And I look at natural gas as an example, copper as an example, corn as an example, and WTI is just kind of bumping up against the upper range. And supply is, I think we're just hitting those bearish stops, which I would have been. Thank God I'm not a trader anymore. And then we're going to revert back downward. And it's just, look at the macro. It's just, I see all the supply is going to come back. This is just and inventories. People talk about how low inventories are. That's how typically when you put peaks in markets, I see inventories bottoming and taking off from here.
Matt, we've got quite a contrast, and perhaps there lies the beauty of the game and the challenge in reading the tea leaves. We've got Citibank projecting a decline over the year to end 22 in the 60s, the low 60s, with an average on 68. And the other side of the street, we've Goldman Sachs calling 100, 105 going into the new year. That's a $40 spread. Where do you sit yourself?
Well, no, I just want to applaud Mike for his perennial bearishness. I agree with him. I feel like he's the only one left out there that I can talk to who's a bit bearish. Look, you're right. That is quite a spread. Goldman's results came in yesterday, and their Q4 results were pretty poor, to be honest. And their stock value's off 6% in the last 2 days. Goldman's, of course, carry a lot of weight. And I had this conversation with a few people yesterday regarding the US investment banks, JP Morgan especially. You know, Jamie Dimon. I mean, he certainly had his Weetabix for breakfast, that lad, because he sees 130 oil at some stage in 2022. I mean, whoa. But those same investment banks, what do they do regarding investment in fossil fuels? Where do they lie with that? And where does that sit with balance sheets like your Chevrons or your Parsley's or your Continentals in the US? 2021, was the year of consolidation for those guys. 2022 is the one where the shareholders say, right, that was good. Now let's capture some of that market share. Let's be more aggressive. Let's have a look at different structures and new technology. And that's what they will do. And I see them coming back. I agree with Mike. I think by the end of Q1, you could easily see between 12 and 12.4 of production back from the US oil players. The Permian Basin is going to be at its record high. All of it's being ignored, Sean. So you can form an argument for 60 oil and you can form an argument for 100.
But ultimately, Matt, I mean, the more this supply comes, I mean, the taking OPEC plus at near full and et cetera, every day that goes by and every one of these barrels that comes back is another day we're closer to essentially having no spare capacity. So when you get a Seyhan pipeline moment, what's going to happen? The price is going up. We've moved into that territory sweet spot where every new barrel you pump is nearly an up rather than a down.
Yeah, look, that is obviously a concern. But when the market starts leveraging off the fact that Libya and Nigeria can't pump as much as they should be, I get concerned, because when have they ever been a consistent swing producer? I thought that, you know, Prince Abdulaziz was here in Dubai on Monday and he was at Expo, of course, because everyone's at Expo apparently.
I was there myself yesterday.
Yeah, there you go. And he said that he wouldn't step in and sort of pick up that slack if people are not producing. So you've got to argue there what is the outlook and what is the objective of the group. They've got to be very considered. But if we can't look at this energy market and just focus on crude oil. In the last 2 weeks, US stats have come out and they've shown an 18 million barrel build over what should be a high demand season. 18 million barrel build in gasoline stock. And that's a gargantuan amount. So it's end user demand, refining demand. Okay, fine. Look, you know, we saw China at 78%, they were down in their diesel exports in December because the domestic demand is poor. This is Chinese New Year season, right? It's only coming up in 2 weeks' time. I can't form a bullish argument for crude oil when end user products demand is down. It doesn't make any sense to me. And I think that there needs to be some market realization against that.
The other piece, Bora, in this sort of trend, this sort of longer term trend, but starting to surface in supporting this sort of price movement, if you like, is the Capex or lack thereof, right, over recent years, last year and the year before in particular. Where do we see Capex now and the ability, willingness, appetite of banks to pump money into new production for hydrocarbons as we start this new year?
Well, certainly the oil industry, as we all see, is moving forward a pace, and even in the US, production is rising and expected to continue to rise. But in my experience, again, I'm not in the industry myself, but in my experience, it is getting over-engineered a bit. There's a lot of focus on net zero commitments and carbon credits, acquiring portfolios of carbon credits from wherever they can. And I understand, you know, global majors are really bidding up the value of these credits from renewable promoters and others who have a pipeline of these in their development strategy. So it's getting over-engineered. And the banks are, and why are they being over-engineered? Because banks are requiring that. Banks are requiring some type of decarbonization strategy and pricing linked to decarbonization for the majors. Now, I don't know how that translates to the shale patch. I can't comment on that. And any type of over-engineered system is at risk of some type of bottleneck, I think. Matt's
but
right.
ultimately, it is that piece that kind of, when you look to those elements of what is giving this market that extra sort of solid floor at the beginning of this year, is the lack of capex, the supply over the horizon, the sort of 105 call by Goldman Sachs into 23 is based on that element rather than too much of other things.
Yeah, I think the markets right now are not looking at the micro, they're looking at the macro. And I think, Mike and Matt, they're looking at the details. They're looking under the hood. But what the markets see is the U.S. is hot. It's growing at pace. Inflation is hot. Talented employees are scarce. Even in the UAE, I saw an article that the majority of workers want to change their jobs.
Even in the UAE,
yeah, even in the UAE, especially in the UAE,
look how
right?
hot Matt is. He looks so hot.
People think they are worth more than the market is paying them now, so they want to change jobs. And with all this expansionary juice in the system, the only thing that has changed is Chairman Powell's tone. So now the markets are looking at him. Well, are you credible or not, given what Biden wants to do and given the investment needs of the U.S. that are not perhaps going to be funded by tax raises? What are you going to do? And let's see. I would like to see those rate rises come in at least begin in Q1, and then we could see a major change in the temperature of the markets. But right now, at the macro level, the markets are hot, and that is what's creating this buoyancy.
Mike, how hot is the U.S. market? I mean, in the sense, there seems to be a lot of the macro data is very positive. It doesn't seem the President Biden is getting any credit for that. But ultimately, are we moving into a post-COVID posture in America? The Supreme Court bashed away his COVID mandate, and we're now kind of moving into post-Omicron, post-COVID, live with it.
Exactly. It's becoming live with it. I have a son who's an MD at Walter Reed, so he's right in the heart of it. And he says, just get used to it. This is an endemic. It's going to be like the flu. People are just adjusting to it. But there's things like, there's a Bitcoin conference in Miami. I'm not attending it. I want to be with 4,000 people with masks on. I'd rather just avoid that. Give it a couple more months, and I think it's all going to be dissipated. But the key thing is, it's that lack of sustainable, incremental, increasing demand. And I mentioned liquid fuels, as I'm talking about, from North America. So that has been the same for 20 years, and now it's heading lower. It's even the same thing in China. And then I just love the difference between the macro and the micro. Most bullish people focus on the Capex. And I get that. But in the US, there's hundreds of independent oil companies. And there's the key thing in commodities, always remember, it's called elasticity of supply. And there's a get or done attitude. When prices move up, supply will come. So it's coming. It's already showing signs of it. And there's also key lessons of last year's trade in crude oil. We've had pretty significant 20% corrections from new highs. I fully think that's more the risk. And I appreciate Matt pointing it out too, is I focus on broad commodities, and that elasticity of supply kicked in all commodities last year. Most notably happens first in grains, because they can supply can come on in a year. It's even happening in copper and industrial metals, most notably because China is incrementally in decline. Just watch that triple R rate. You never want to be bullish commodities when they're cutting their triple R rate. And that's been the lesson for the last 10 years. And then there's a macro. So I look at it as this is a short-term blip. I fully expect that we're going to have one of those days. We're going up on the escalator. We'll have a down in the elevator day. And I just look at it as a trader. If I'm getting long here, I fully expect you get stopped out in 20% decline, and then it'll go up if I'm bullish. But that's the way it works.
Mike, on that point, I mean, the potential for a kind of a sort of interdiction on this market, the likes of Biden not re-election, but the midterm elections this year. What is his wiggle room vis-a-vis the Ukraine crisis? We've got obviously Powell, Bora mentioning the Fed getting over exuberant and maybe really putting the brakes on hard. Some event like that is just not sort of factored into the market. What do you see the likelihood of that?
Biden needs a miracle right now. If there was election today, he'd be toast. It's just his polls are down, everything's negative. It's just nothing's good for Biden right now. He needs something to change, and the economy that the Fed and the Fed's working against him now. The Fed's going to be raising rates, the stock market's going down, and I fully expect by the time we get to the election, that's a bad thing. So the bad news for supply is once you get more Republican environment, that's more drill at will, and what happened with the Trump administration. So I view this as we're going to look back at this as that yet crude oil's been going down since 2008, 2014, and this is a bounce in that enduring trend. And the fundamentals are worse. It's all leading from the U.S. I mean, the average cost of liquid fuel of crude oil production in this country is below $50 a barrel. In 2014, it was $70 a barrel, and that's with this unlimited rally in money supply. Now, money supply is going negative now with the Fed raising rates and doing quantitative tightening. It's just right now they're just jawboning. They need markets to go down, and crude oil is doing the wrong thing for them. It's easier for them. I'll end with this. It's either them to not tighten and just jawbone and let the markets do it for them. And crude oil is the one thing going against them at the moment.
I'll be interested to see if they do lose their bottle, so to speak. Let's go to the survey question on the day, which is looking at this idea of post-COVID or not, where we sit. New COVID variants of concern and renewed mobility lockdown restrictions will disappear in 2022. Agree or disagree? This idea that we've moved beyond the tolerance or the appetite or even the need, perhaps, for this level of reaction is no longer going to be there. Do you agree or disagree with this statement? Matt, refiners seem to be doing okay. Margins looking pretty solid with the reduction in gas prices in Europe.
Yeah, that's all looking good. I mean, that's gone from, say, the gas oil crack in the EU has gone from $5 a barrel this time last year to 14 now. So yeah, it's all looking rosy. But again, and I know. Excuse Bora, just by the way, excuse Mike and I for looking at the details about the market. I know that's a real downfall that we've got there.
That is not permitted. No.
No, but it's a good point, and I think that is the sort of ebony and ivory market we're in. We've got traders looking at the macro picture and ignoring the details. Is COVID in the rearview mirror? Well, yeah, it might be in the rearview mirror, but whilst I'm driving to go and get a PCR test, yeah, exactly. So it's very much with us, and it will be interesting to see what the market reaction will be when the new variant sadly is announced. I think that based on current sentiment, if they're one that comes out, whatever the next letter in the Greek alphabet is, excuse my ignorance there, if the market says, oh, I'll dismiss that, it's no longer a concern, I'm not concerned that government intervention is going to happen, then that could easily spike us back up to 100, because that really would be a sort of sign that the market is saying, yeah, here's COVID. It's not that concerning. It's a new variant, yes. And then the world will come back to where it was pre-pandemic.
Well, it seems unlikely we will see a dump before the news, if you like, that the Omicron reaction of the world is ending, $10 down, that repeating itself seems unlikely.
Yeah, I think so. I think, it's interesting. Again, I come back to the details, and I'm talking about fundamentals here. And the only short-term indicator for demand is EIA data right now. That's really what is anything tangible. And like I said, if there's another gasoline build tomorrow, because it was Martin Luther King Day on Monday, so stats are on a Thursday, what does the market do? Does it say, okay, well, that's now 3 weeks so far in 2022, we've seen builds on gasoline, and does it just react to crude oil draws? That will really set the tone for 2022. Just on China a second, and your survey question today, I listened to an interview with the Chinese correspondent for the Economic Intelligence Unit yesterday, and they don't predict that China are going to fully open borders until 2024. So when we're talking about a fractured recovery and what does COVID mean, and you've got the world's second biggest oil consumer floating between first and second, locked down still, it has to have an effect on demand. It can't be ignored. But, it seemingly it can. So what do I know?
Bora, always like to go local on occasion. Do you have the Boris update? Can you be our Boris correspondent? Will he be prime minister this day next week? Is it of any relevance to the world?
Next week, I don't think it's of relevance to the world. I definitely don't think he has that weight. And I think it's 50-50. He has a few allies. Dominic Raab is stating that he's with Boris and that a prime minister who has told an untruth to the parliament must resign. So he's kind of saying he backs Boris at the end of the day. So these Tories, they're very
you get what you pay for. That's
disloyal bunch to each other, and who knows what the intrigues will be there. And but
on more
definitely,
important matters. On more important matters, where does the European solidarity vis-a-vis Brexit now facing its first significant potential geopolitical crisis in Ukraine? Do we have a common European position? Is there a fractured, even weaker Europe? What does that feel like?
No, I think this is the key point that is creating tension in the world is, we look at Powell, we don't see the credibility. The market is sort of playing chicken. We look at Biden and Boris, and who's this guy, socialist guy in Germany? I don't know if these Russians, Chinese, Iranians feel deterred by these players, but they should be, because these are important, well-established states, right? The Western democracies. And so there is this risk of miscalculation. Miscalculation in little aggressions like these Houthis took toward the UAE that can spiral out of control. And I don't know how the market factors that in. Perhaps they're not factoring that in, but this is the tone of our times, is that the masses, the herd, is getting kind of ahead of the contrarians like Mike and Matt, and I think the contrarians are usually right? But you don't want to be under the hooves of the herd either, unless you have the sort of gravitas and liquidity to do that. But all in all, I think 2022 is going to be geopolitically very unpredictable, and there's high risk of miscalculations given the perceptions that our leaders are not up to task or not going to be around after the next midterm or the next cabinet reshuffle.
Let's get the survey question result. Give Mike last word. Agree new COVID's lockdown will disappear in 22. Mike, on that last point, clearly the idea that we are in that sort of geopolitical challenge this year as a bigger factor than normal, perhaps. Your thoughts on what other major trends might play out this year?
Well, crude oil is a key one. I just look at it as having all my years covering customers. Right now, if I was on my desk with customers, I'd be structuring put strategies in crude oil with the expectation that, maybe it goes up another 5, but an equal probability it drops $10.
The bigger moves to the down than the upside. That's the call. Whether you want to be in for the last few bucks, that's what Omar Najia has been talking about for a few months now. He's not interested in the last few bucks. Well, I'm not interested in keeping your time anymore. Mike McGlone in Miami, thank you so much for joining us. Bora Barryman in London, Matt Stanley in Dubai. Really appreciate you coming back to the table in the new year. Best of luck over the 12 months ahead. May all your predictions come through, and may you come back often. Thank you, everybody. We'll catch up again.